Hello and welcome back to the GNAT TV News Project. I'm Andrew McKeever, the news director here at GNAT TV. Great to have you with us today as we start a new series of programs on life skills or how to deal with some of the vexing problems we all encounter at some point along the road in life. Questions like how to rent an apartment, how to buy a home, how to start a business, or as we're going to talk about today, how to buy life insurance and home insurance. And with us today to answer some of those questions are two distinguished professionals here in the community, Andy Shaw and Craig Powers, who are the co-owners of Shaw Insurance Company, a very well-known firm here in town, been in business for over 100 years here in the community. And gentlemen, we're great to have you with us here. Thank you for making the time to come down here and talk to us about this.
Thank you for having us.
Well, so Craig, let's start with you and let's talk about the life insurance side of things here. I guess I'm just wondering, maybe just to get us started here, what is the point of buying life insurance? Is there more to it beyond just simply having, in the event of, well, we're all going to pass on at some point or another, just having a benefit that would go to a spouse or surviving family members? Is there more to it than that?
Yeah, life insurance is a product that can do many different things. It can provide a death benefit for a spouse. It can provide a bucket of money, so to say, to pay for final expenses, for business expenses, for continuing costs such as mortgages and college expenses for kids. And one last thing it can do is it can provide a bucket of money in a business situation for a buy-sell agreement between partners of a business, like Andy and myself have life insurance. If Andy passes away, there's a bucket of money for me to buy his shares out so that the business can continue. And there's also another point called key person life insurance. We have employers in town who have key employees that if they were to lose would be irreplaceable from a financial standpoint. So we actually insure the lives of key employees so that that bucket of money can come in and help to train a new person if that key employee passes away. There's tremendous amounts of uses for life insurance.
So at what point should someone start thinking that they need to buy life insurance? I mean, would this apply to someone who's, let's say, in their early 20s, just out of college, starting their first job? Do they need to think about buying life insurance, or is this something that kicks in later on?
My experience in the 17 years of selling life insurance is that our little agency doesn't get a lot of calls from 20 and 30-somethings. They're not thinking about their death because they're young and the world is their oyster. And they also don't have a lot of assets to protect at that point in life. So, if they die, who cares if they don't care. When we start to see people get interested is when they purchase a home, when they get married, or when they have children. That seems to be the real catalyst of when we get a lot of the phone calls. And then again, we do get calls from older people, old meaning 50s, 60s, 70s, who are concerned about estate planning, making sure that their spouses are taken care of, things of that nature. But the bulk of the calls that we seem to get are 30, 40, 50-year-olds who are starting families, starting businesses, and buying houses.
Okay. Now, I know there's a couple of different kinds of life insurance, and the two broad categories seem to be whole life and term life.
That's
correct. Can you tell us the difference between the two?
Absolutely. Term insurance is for a specific amount of time, either a 10-year period, a 20-year period, 30-year period, maybe even a 5-year period. Your price is basically set on an annual basis. You pay the same amount for a specific bucket of money, let's say $500,000 of death benefit. You pay that same premium for like a 30-year period, and if you pass away in that 30-year period, your named beneficiary would get that $500,000 bucket of money. Pros and cons. The pros of term insurance are that it's actually the least expensive product that's available. The con is that at your 30-year end of that policy, your premium would probably be pretty prohibitive. Maybe you're in your 70s and your 80s and your health isn't that great. And if you want insurance past that point, you're either going to pay for it or you're not going to be able to afford it. Whole life will run from the day you buy it basically until the day you pass away. There also is a bucket of money available in the whole life policy that you earn over time, and you can draw loans off that money, and that money becomes part of the overall death benefit. So the pros of whole life insurance is that it will run until you basically pass away. The con is that it's usually double, triple, and sometimes quadruple the cost of a term policy.
However, develops a cash value.
But it develops a cash value. So you get into your 80s and you don't want it anymore. You can really call the agent and basically say, I want to terminate that policy, and possibly the cash that has built up in that would become your bucket of money. So you can use it as a savings vehicle to build up a cash bucket of money over time and also have life insurance. But the downside of that is they're paying very paltry interest rates on that bucket of money as a savings vehicle. You can do a lot better in the stock market, I believe.
I just wondered, is there some sort of general guideline or formula within the industry about how often you should review your life insurance policy, or maybe consider changing from term to whole life, or is there some kind of general rule of thumb around?
There really, not that I'm aware of, there isn't a general rule of thumb. Most of the insurance policies that we sell are term insurance. Doing this 17 years, we have policies, let's say it's a 20-year term life policy, they're 17 years old now and that are going to mature in 3 years. The customer is maybe 55, they still have kids in college. What do you do? Generally, we'll put a reminder in the system, our computer systems, to try to reach out to that person and see if they would like to possibly buy more as an extension of that policy, or buy another policy for a 5-year period or maybe a 10-year period for a lesser dollar amount. So basically you're running 2 policies at once that if you were to pass away, you would get both buckets of money.
Before we leave life insurance here, I just wondered, how much life insurance should one purchase?
Great question.
I guess this comes down to like, how much is your life worth? But is there,
Great question.
Is there some kind of formula around that says, well, if you're making X thousands of dollars a year in income, or if you're doing this or you're doing that, are your needs different?
It's going to depend on the specific situations of what your asset base is that you need to protect, what your liabilities are for the money that you owe, what your future liabilities are going to be for kids' colleges. What's a kid tuition now? $55,000? You'd know better than me. But
yeah, that's a good number.
Is that a good number? What I like to tell potential customers calling in is, what do you think? And then they say, I have no idea. And I say, how about 250,000? How about 500,000? How about $1 million? And I throw those numbers out to the customers, and typically a young couple with an average house here in Manchester, basic income, usually will pick a $250,000 term or a $500,000 term policy. That's, I'd say, the median for this area. I have written a couple policies before, Andy, that were $1 to $2 million, and these were big CEOs of pretty substantial businesses. I think the easy way to determine this is what would be your spouse's needs if the main breadwinner were to pass away and you need to replace their income. Take that income, their gross income, and multiply that times 5 or 10 years. Look at your liabilities. How much do you owe on your mortgage? How much do you owe on your car payments? What are your future needs for educational expenses for your kids? It's hard to peg those all down, but I think when you put them into buckets of money like $250,000, $500,000, $750,000, that tends to encompass a lot of what people need. And when you pass away and you make a claim for that death benefit, the insurance company will actually write you a check for $750,000, provided that you meet the claim requirements, and you can have a huge party if you want to.
I'm sure that's probably happened at some
It's
point.
probably happened. It's probably
So,
happened.
are there any? Well, last question then.
Sure.
Are there any hiccups then when that happens? I mean,
No.
you know, if you've had your policy, you've paid your premiums regularly through the years.
Life insurance
There's
is
no real
life insurance is
pitfalls
pretty
there.
cut and dry. I mean, they're typically you need to provide a death certificate from the state, Vermont, New Hampshire, wherever you pass away. That has to go in. You have to fill out a claim form. And I would say for the most part, I have never in my 17 years seen a life insurance claim denied. The one big thing that they will deny a life insurance claim on, which I tell all my customers, if the person insured commits suicide within 2 years of purchasing the policy, they will not pay the death benefit. That is the only real exclusion in the policy that I'm aware of, other than
That's in the contract.
that's actually written into the contract.
So no one could say they didn't know that.
Correct.
When they took it out.
And fraud. I mean, if you fraudulently represent yourself as not having lung cancer and you misrepresent, which is a fancy word for lie, and the insurance company finds out about that, they're probably going to deny paying the claim. And how they figure all that out is there's a huge database of medical records that they can get into to review and underwrite your account with just a signature from you on the application giving them permission to do so.
So if you have some sort of pre-existing condition, that
Your
you don't
price,
tell,
your price is either going to be very high if it's a pre-existing condition, or they're going to deny you right up front.
yeah, okay.
Alcoholism is a big one. People tend to not think that they have maybe a drinking problem, and will sign the customer up for the life insurance. They'll go through the underwriting, which is an interview as well as a medical exam with blood and urine samples, and they can pick that stuff right up on the medical exam in about a minute. And then the life insurance company would come back to me and say, well, the $1,000 a year premium that you quoted is now going to be $40,000. Would the customer like to buy that policy?
And they won't give us the specifics.
They will
because of
not
privacy.
share the
They'll just
medical
say,
information.
Our
with-
medical tests show that he can't get that good rate.
Yeah, they'll just say, well, you're going to pay 40 instead of 1,000, and we're not going to tell you why. And then we have to refer the client looking for the insurance back to their physician and have a funny, or not a funny conversation, but a frank conversation
Yeah.
with their physician.
So I guess honesty is the best policy.
Honesty
huh?
is the best because they will catch
Yeah,
you.
okay.
Yeah, there's no hiding health issues generally.
All right, interesting. All right. Well, Andy, let's turn to home insurance then and talk about that for a few minutes here. I guess just to get us started again, like what are some of the factors that are in play? If someone's bought their first home, what do they need to buy or cover or protect
Yeah,
at
well,
that point?
your home is, for many people, a very significant asset to acquire. And so homeowners insurance exists to protect that asset. And furthermore, in most cases, there's a mortgage involved. So the bank won't lend the money until they know that homeowners insurance has been put in place, so that the place doesn't burn down and be left with left with nothing. Homeowners insurance, you basically need to purchase coverage to reflect what it would cost to rebuild that home, and that's how the insurance companies set their rates. They look at the total insured value, which would be the replacement cost of the home, and that is a different number than market value. In the current real estate climate, we're noticing that a lot, is that in general, currently, the cost to rebuild a home is probably higher than what it would cost to buy that home. So we have that conversation.
Why is that?
Well, it's construction costs haven't changed that much. The cost of lumber and nails and labor. If you went out to build that same 3 1,000 square foot home or that same 1,500 square foot home, it's likely would cost you more than it costs you to buy that home. And that's what insurance covers. So that's what the insurance companies insist, that you insure it for reconstruction cost. And they look at various factors in determining that, but basically one of the most significant is the square footage involved, and then the grade of the construction. I mean, you can have a widely different replacement cost based on whether it's just a modular home or if it's a custom built home, and so that all goes into it.
Now, should the buyer, do they have an option or a choice to kind of cover different scenarios that might happen, like fire or theft, burglary, weather damage? I mean, is that all rolled into one thing?
The insurance
or?
companies have developed the homeowners policy, and they've tried to make it something that can be written for a wide range of situations. So they pretty much dictate what the perils that they're going to cover are. Typically, they don't cover flood, they don't cover earthquake,
War.
Rot is not covered, war is not covered, and coverage is available for flood and earthquake, but it's separate. Primarily, they're going to cover those other perils: wind, hail, lightning, fire. Your car hits your house, things
Vehicle
like
damage,
that.
aircraft damage,
Yeah.
volcanic eruption. That's a big one that we do here.
Even here in Vermont.
Yes,
huh?
exactly.
And
When was the last volcano erupted in Vermont?
when I started way back when, there was actually different levels of homeowners policy that you could select. You could get the basic policy that just was fire and lightning, and that was it. But again, a lot of it is driven by what the lender wants you to have, and so the lender says you need to get the deluxe policy with the broken pipes coverage and from freezing and things like that. So there's not a lot of selection. They also set it up so that in addition to insuring the house, you also have personal property, which is the contents, your clothing and pots and pans and televisions and all that. And they will add that into the policy as well. And a lot of it is dictated by how much the house is insured for. They have a formula where they're going to cover the personal belongings for 70% of the value of the house or 50% of the value of the house. And then the other component to homeowners insurance is liability insurance. Just like in your car insurance policy, you have liability insurance if you hit another motorist. Your homeowner's policy will cover what they call personal liability. And that's if someone came to your property and was injured and felt that you were responsible for that. Your dog bit them. It's not just
Fall off the
specifically-
trampoline.
Right, you could fall off the trampoline. And we chuckle a little bit about that because now when you're going to buy a homeowner's policy, there's a laundry list of questions that the underwriters ask, and they ask you, do you have a dog? And if so, what kind of dog? And do you have a trampoline? And if so, does it have a net around it? And in my career as an insurance agent, there seems to be more and more questions about liability prospects than there used to be. It used to be, where's the house? How far from the fire station is it?
Right.
Voila. But now they ask a lot more questions about those potential liability issues because as society has developed, liabilities become a bigger.
So is that optional for the home buyer? Can you say, well, guess what? I'm going to take my chances, or I'm a nice guy, and things like that aren't going to happen to me. I don't want to spend the money on the liability.
There are some companies that might let you buy it without liability, but you'd likely be in what they call the excess market to get that. So the typical company is going to have liability.
Yeah,
it
property
comes
and
with
liability.
the deal.
Yeah,
It's part of the. It's a part of the package, so
Okay.
it's not really optional. There's different levels. You can buy $100,000 worth of liability. You might have $200,000 on your house to replace the house, and $100,000 on your personal property, and you could bet $100,000 liability. You could get $500,000 liability. You can get $1 million liability.
Depends on if you want to protect your asset base from lawsuits. If you're wealthy and have millions of dollars in the bank, you might want to buy $1 million worth of liability for the trampoline issue.
And it's also that personal liability component. Also, it's not just limited to your premises, but for example, if you're out playing golf and you shank a shot, into the road and hit a passing car or something like that, we've had claims for that kind of thing. That you have personal liability in other situations than just on your own premises.
Right,
The premises is usually the big exposure, but not always.
Right.
You're hunting and you accidentally shoot another hunter.
Comes up.
That would be a liability issue.
I was wondering, as you were talking about, protecting some of these various assets and pots and pans and clothes and stuff, does that apply that you should have photographs of all of these belongings, that you want to make sure you can make an ironclad case to should the worst happen, hey, yeah, I actually did own this.
Absolutely.
And here is the picture.
Yeah, absolutely. To have a home inventory would be
Optimal.
very important when it came time to present a claim. There's a certain amount of trust where if something happens, the insurance company, the house is in ashes, they're going to say, have a legal pad like you've got and make a list of everything you had, and then how do we know you had that? So yes, any type of documentation would be certainly a big help in taking care of a claim should the unthinkable occur. And photographs would be great. Of course, you'd need to keep that inventory at
someplace
your mother's
off-site.
house or in a safe deposit box, because if that's burned up too, it's not going to help.
I think a great suggestion is to take your cell phone, stand in the center of each room in your house, take a video, pan around, shoot that out to your email, and just store it on the cloud. And there's your inventory. You can actually reference that as you're doing your inventory sheet.
Is there any rule of thumb around how high your premium should be or how much insurance one should carry? Is that
Well, again,
tied strictly to the value of the property?
With
or-
homeowners insurance, it's pretty much tied to the reconstruction cost of the dwelling. That's basically what's going to be the basis of it. Now, there are some restrictions in policies having to do with, when we talk about personal property, certain types of valuables, where they have a limit in the policy. We're not going to pay more than $2,500 for theft of jewelry, or $2,500 for silver. There's some limitations on guns. The insurance companies have, figured out that those types of property really need to have verification in order to insure. So they might say, if it's more than $2,500 worth of jewelry, you need to buy extra coverage on that. But the overall governing driver of it is going to be how much to rebuild the house. One of the factors that also affect the cost, how old is the house, what kind of roof does the house have, how old's the plumbing, and another thing is credit score. As the insurance companies in the past decade have all adopted the use of credit score as an indicator and another factor in how much they're going to charge you for insurance. And different companies have different matrices that they follow, or algorithms, and but credit score is pretty much universally used in conjunction with those other factors.
Actuarially, they say that the poorer the credit score, the more likely is that claims will be put in. That's the actuarial reasoning behind the use of a credit score.
Oh, okay.
It's illegal in Massachusetts.
Right.
I believe you cannot be, your homeowner premium cannot be factored on credit in Massachusetts. In Vermont and other states, you can.
I think only there's 3 states that don't allow it. But Vermont, where we
is
do
not
business,
one of them. Yeah.
Interesting. I never would have thought there would have been a connection between the two things.
It's quite a
there.
conversation when a customer calls in.
I bet.
And we have to advise them of that. And
And if I recall correctly, sort of the magic line on credit scores around 740. If you go below that, you're
And we
getting the
actually
shaky
don't
water.
see the credit score. We're in the dark about what the specific
Okay.
credit score is. It's all done behind the scenes, and then it's put into a matrix. If you have a poor credit score, but we find out that you pay your bills to this company, well, we might give you a better premium. I mean, it's a lot of different factors, but if you boil it down, the poorer the credit score, the higher the homeowner premium is going to be, unfortunately.
I just was wondering, since this has been a conversation piece around health insurance, which we've been hearing an awful lot
Yeah.
about lately, how competitive is the home insurance market? Are there different agencies that offer different packages, and they're kind of fighting for the
Yeah.
business and trying to make
Yes.
good deals? Or
Yes, and, we're an independent agent, so we represent 7 or 8 companies that offer homeowners insurance, and we have the ability to, look at the big picture. A lot of times you can maximize your savings by partnering it up with auto insurance, but not always. Sometimes you can get a better deal with auto insurance with one company and home with another. Sometimes you get a package. We can look at all those factors, and then there's other insurance companies out there that have dedicated agents that are not independent agents, where you're just going to get a quote from that company, that one company. What I would say our advantage is we have several different carriers we can look at and determine what works best. And it is competitive.
It's very
Yeah.
competitive.
Yeah.
Okay, interesting. Well, we have time for one last question, and I'll just throw this one out there because it was one that I happened to notice on when I was filling out my last insurance form, and that's terrorism insurance. I guess it's optional, right? You don't have to have it, but
Terrorism
What
insurance.
is that?
Terrorism insurance is something that applies to commercial insurance.
Oh,
It
okay.
doesn't. They won't ask
Primarily
you that when you're
commercial
doing
insurance.
personal
Yeah.
insurance. But with commercial insurance now, there's an optional with some companies buy-in to include terrorism coverage. Now, for it to meet the threshold, it has to be an event that's declared an act of terrorism by the
Treasury
Treasury
Department,
and
yeah.
it needs to be, causing more than $25 million damage, or maybe it's 50 now. So it's
Yeah.
it's not a small incident it's going to trigger.
It
such
all
a thing.
happened after 9/11
was
because
wondering,
there was
yeah.
a question on whether terrorism was covered with the Trade Center or whether
Yeah.
that was an act of war. So the U.S. government started partnering up with the insurance companies and basically saying, you're going to need to cover this peril. And so the insurance companies started saying, okay, we're going to cover this peril, but we're going to charge to do so. And again, it's almost all in commercial policies. I would say 90% of the Manchester business community does not buy the terrorism insurance. I would venture that guess.
Yeah, yeah.
Because it's a fairly big charge on a $20,000 account. It can be $400 or $500 extra dollars. And they say, well, you know what? If they're going to drop a dirty bomb here, we're probably not going to be alive anyway. So
yeah.
that's
Well,
the chance they're taking.
Well, I was wondering if it was limited to like sort of 9/11 style events. God forbid we don't have to have any more of those.
Yeah.
Or if that was more a random shooting incident or something like that.
Yeah, a random shooting event wouldn't fall under that.
under terrorism, that would probably fall
definition.
under something else.
Yeah.
Okay.
Would
Yeah.
be our guess.
Well, I'm sure there's a lot more questions that we could drill into, and hopefully the folks who are watching the show got some ideas about some of the questions they might want to ask should they find themselves in the market for home insurance or life insurance. And I want to thank both of you for being
Very
here
welcome.
today to share your wisdom with us all. Craig Powers, Andy Shaw, great to have you both,
Thank you.
both here, and great to have all of you folks with us as well. I hope you'll follow along as we explore these other problems of life, like I said at the start here, buying a car, buying a home, starting a business, whatever it may be. We all run into these little problems at some point or another, or hurdles we have to get over. I often thought that I should have taken a one-credit course back in college on all of this stuff.
Yes. Yeah.
Pass, fail, definitely.
I wish they offered it.
And I could have learned a little bit more about that before I stumbled out
The
into
real
it.
life
Yeah.
issues they should
Yeah.
teach
Right.
you at school.
All the stuff they don't teach you about in college.
Yeah.
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 Or high school or wherever.
Yep.
Anyway, thanks again, and we'll see you the next time.